Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us how the last decade was outstanding for the equity markets, and it really didn't matter who was in the White House. He also takes a look at interest rates, the U.S. dollar, natural gas, commodities, marijuana stocks, cryptocurrencies, and precious metals. Market historian Bob Hoye will answer some listener questions about gold's relationship to the bubble of everything and whether the Fed really is in control of the U.S. economy. He also gives us his opinion on whether the unrest in Hong Kong has major implications for China in general. Plus, at the end of the show, we'll have a company showcase update from American Manganese President and CEO Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Best of the season, Ross.
And the best to you and all the listeners, Jim.
Ross, we're going to have a bit of a different format for our listeners who are used to you doing just how the markets did for the week, and then we go to some other guests. Today, Ross, you are one of the big guests, plus your partner, I won't say in crime, but in business, Bob Hoye.
Yes, well, Bob will give you the story behind the news, and I'll just give you what happened in the markets and, what the chicken scratches told us along the way, and maybe what they've got coming up in the next few months. Because with my work, I try not and be too much of a forecaster, because I find that the more times that I have things well established in my mind as to how they will unfold, the greater the chance of a surprise.
Well, first of all, was it a big surprise for you that this was one of the biggest decades ever for equities?
Oh, without a doubt. Absolutely without a doubt. I mean, back in 2008, 2009, when the market crashed, I got all the signals that I would expect to see at the end of a market crash, like we had in 2002, like we had in 87, etc. But to actually believe at the time that degree of pessimism and fear would be followed by a decade like we've had. I mean, here's the S&P is up 200%. The Dow's up 173%. And you've only had one really big correction. Most of them were less than 20%, which don't even count as, quote, bear markets. So this has just been one exceptional run. And, we've picked off some nice interim lows and highs along the way. But there's no way in the world that I ever thought that we would be sitting at these levels by the end of this decade. And when you play with the numbers a little bit here, I mean, you put a bit of politics into this. Trump likes to talk about all the record highs in the market and how well it's done since he was elected, let alone since the inauguration. So we're up 52% on the S&P since November of 16. Obama's 8 years was up 190% from when he took office. And if you look at them on an annualized basis, they're both just shy of 15% on an annualized return. So, this market's been in a steady move for the better part of this full decade, from March of 2009. So now this year, Santa Claus came, or last year came late, and this year he's ahead of schedule for the marketplace. 1 year ago, we were down 19% from September into December. And the fear of the recession was high on everybody's lists. The Miller probe was in full swing. Interest rates were rising. And on November 24th, we saw the biggest correction since '09. The fear and greed index was at 2, and that's on a scale of 0 to 100. So this was extreme fear. And we got one of our S&P capitulation signals. That is when you've got a significantly downtrending market where the short and medium term signals are going oversold simultaneously. We've only seen it 7 times since the crash in '87. And for us, when you get that kind of despair, it just presents huge opportunities. The old adage that what you fear the most is least likely to occur, and when you're crying, you should be buying. Well, that's exactly where we were at that point. So, we looked here this fall. The objective was to see if we could create an oversold condition in October, November, and we got exactly that at the beginning of October. Breakout right at the end of October above the resistance highs, and that meant that the seasonal play was ready to happen. And look for strength right through, as we've talked about, through the end of the year. So this rally, as of the end of the week, is up. We've got 58 days since that October low, and in most pre-presidential years, that rally will last 55 to 75 days. So we're now into that classic window where you would expect to see some kind of a high. And relative strength is high. It's up at 78%, nicely into overbought territory. If it develops into a divergence in the next week or two, that would not be surprising. The decennial pattern that we look at, which being the 9th year in the decade, we look back all the way to 1900. In all but 3 years, you will see a top in early January. And so you take a look, that first week of January is historically part of the Santa Claus rally. But by the time you get to January the 8th, if it starts to roll over at that point, you want to move to the sidelines. So if you've got short-term capital that you're, a little overextended on, do not risk beyond the lows that we see on the 8th. And, the other thing, we got the fear and greed index right now was, as I say, 2 a year ago. It's at 93 right now. So you've got extreme greed. That's why it's necessary to have protection. I've got the NASDAQ Composite Index with an upside exhaustion alert. I've only got 5 of these in the last 2 decades. So this kind of thing says that we're overextended, and it's, for all that it feels good, it's time to be cautious.
Has the U.S. dollar topped?
Well, this is an interesting one. We ended up with I like to look at big cycles and then all the way down to the daily patterns. And U.S. dollar's got a big 16-year cycle. And that one, it topped out in 2017. So if we look at the action going forward from there, we had a hard break into the summer of 2018 and a good recovery rally since then. Now, the first part of that, the first year, it was really had a lot of momentum to it. But in the last year and a half, it's just been grinding its way marginally higher right up into September of just 4 months ago. We got a double top up there, and as of today, it's only up 1% on the year. So it's not only lost its momentum, if anything, it's starting to roll over, and it's down at the bottom end of a rising channel. And depending upon the index you use, the DXY, that channel is around 96.5, and it's challenged that, I guess, half a dozen times here in the last 18 months. And we would expect that if it slides through that and the average starts to roll over as it appears it is right now, then this whole congestion and consolidation will probably be enough to drive it down by about 4 points or so. So we're looking at targets down in the 92.5 level. That would be a nice Fibonacci retracement of the rally off of 2018, be a 62% retracement. And when we look back at this 16-year cycle, the bounce that we had into September of this year is similar to what we saw in Q2 of 1989 and Q4 of 2005. Most of those were the bounces after the first hard breaks. And so now, as we start to roll, the targeting here should be with a fairly quick move to the downside, which I'm sure that will make President Trump happy, because he's been trying to talk down the dollar here for the last, 2.5, well, probably longer than that, well before he was elected.
What does all this mean for commodities?
Well, clearly, a lot of the commodities are priced in U.S. dollars. Internationally, things such as crude oil, but also just, domestically, everything's priced in, if you're an American or, Canadian, you're seeing the effect of the currency and what it's doing there. So if the dollar starts to give up ground, as it has been since September, where it's come from 98 and change down to this 96.5 level, it means that items that are priced in U.S. dollars are going to go up in price. There's no more value to it, but they're going up in price. So if you look at the ETFs, and there's the agricultural ETF, the DBA, and there's the more diversified DBC, which includes oil and number of items in there. Those bottomed in September, right in line with the top of the dollar index. And we like to see, extremes here at lows, and that's exactly what we got. The DBA generated capitulation alerts, and the DBC had a slightly different pattern. It had bottomed a year earlier and double bottom in September. So that's generated a very rare sequential 13 signal. And these are quite often seen as part of long-term reversals. So the recent rally from September has put both of these indices into overbought condition on the daily charts, and they've just tested the resistance of the last year or so, which is perfect. So that's what you want to see as you're coming out of a base. Your first sign of strength off the low, then you get a pullback, which is what we would hope to see in the near term here. And then once you start to break out through there, you can have a fair amount of potential on the upside. So with the way these commodities have been driven down, and you take a look at the price of wheat and corn, soybeans, all these things are down near multi-year lows. Yes, they've bounced, but there's still quite a bit of room, I think, left once they start to gain a bit of momentum now.
Oil is closing the year on an upswing. What's your take on it?
Well, we've once again, long-term cycles have said we should be up into two periods here. One would be into the second quarter of this year. Actually, February through April is the optimum, and with a major top somewhere in Q4 of this year through May of next year. And the $52 low that we saw 3 months ago was right at the bottom end of the trading band that we have. And the objective then was to look for the first overbought reading, looking for a relative strength index up at 80 or higher, and we're at 72 as we close off the week. Ideally, you want to see a nice spike up into that 80 range as part of an interim high. Now, if that high were to happen quickly now, then we would look for a pullback, maybe, towards the lower band, And an oversold reading probably takes you down into the $54 range as a possibility there. But if it starts to just grind sort of methodically higher without becoming excessive, then that high will probably be in the February-April window, which is where historically this first rally off the important low that we saw as part of the 10-year cycle there. That one should be followed by a decent correction. So interim high now if it gets ahead of itself. Otherwise, look for further strength. Good setback, and as we move into the fourth quarter of this year and into next year, I think it can easily be looking at levels that are in the $75 to $100 range by the time we're out a year from now.
We'll have more with Ross Clark when This Week in Money returns.
Always consult your investment professional before making any investment decision.
Cyprus Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cyprus Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cyprusdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Ross Clark. Ross, is there a seasonal play coming up in natural gas?
Yes, natural gas usually has two good runs in the year. One is a rally into a nominal high in the fall, and as you're moving into the colder weather, and there's a buildup of inventory that causes that strength. So typically, you would see October, November have a nice little run, and we saw exactly that this year. The price managed to go from 220 up to 280, and it's been settling back down around the 220 range to close off the week here. Now, when we look back, we got 22 years of history in natural gas, which is reasonable when you're looking at seasonal analysis. And so, in the first quarter of the year, there has been a really good buying opportunity, typically in January through early March. And what we like to look for, and what shows up here, is an oversold reading. We look for a sequential 9. So that's if we get 9 consecutive days with the price closing below 4 days earlier, then we get a sequential setup. And 19 out of 22 years, we've seen that in that January through early March window. And the bulk of those have resulted in very, very nice multi-month rallies. So there's no specific time date here that we're looking at. Quite often on seasonals, you'll have a time window of maybe a week or so that you're looking for a potential turn. But in the case of that gas here, it's more price discovery that we're going to look for here. When the pattern completes, it will be time to move. You'll probably have the better part of 3 or 4 days ahead of time to know that we're getting into the oversold condition. And as I say, in most years, we got that nice oversold, and actually there were 3 of the years that were so strong we didn't get the sell-off, so we'll look for the characteristics on those previous years. But this tends to be an attractive one. The other one in the complex will be the unleaded gas as we move into the driving season in the summer. Changeover in the gasoline mixes, etc., usually causes a pretty good run there. And that's a seasonal that we'll be publishing for any of the subscribers probably as we get into February.
Ross, are we expecting some large moves in interest rates?
Well, this was the year for big rate moves. I mean, take a look at it. Here we got, a year ago, you had short-term rates up at 2.4%. We're down at 150 as of this month. You had the 10-year bond rates up around 3.25, got down to 145, and they've been stabilizing. So from our technical perspective, we saw extremes in July, and saw a pause there around on the little 10-year bond. We saw a pause in July after seeing some good technical extremes. And then it went on to have a second run down to that 145 on rates. And at that point, all of our daily, weekly, and monthly oscillators just kicked up some huge reversal signals. And we've seen rates at this point come back and start into a broad consolidation area. So the long bond currently has a 187 yield, and it's boxed itself in. And so the pattern is beautifully set up then for a breakout. Anything through probably 195 will be significant, and I would look for, at that point, probably a run to maybe the 240 to 2.5 level on interest rates. If the level of support down at 170 gives up ground, then we're probably looking at new lows. So probably relates to the strength of the economy as we move along here as to what's going to happen. And, the yield curve has been inverted in a lot of the markets since the summer. That was one of those items that everybody was so fearful about, and it had gone from a page 16 story to a page 1 story. And everybody thought, oh, here we go. Markets are going to roll over. Stock market's going to be in trouble. But in reality, when you get an inverted curve, it's a huge leading indicator. It can be up to 18 months before the stock market tops. So as far as interest rates are concerned right now, we'll keep an eye on the spread. The inversion in the U.S. side on the 2s versus 10s is gone. If that starts to steepen, then we'll look at that as a cause for concern as far as equities are concerned.
It wasn't such a great year for pot. How come?
No, it sure wasn't. This is another one of those items. Buy mystery and sell history. October of a year ago, here we got legalization of pot in Canada. And the stocks, it was a classic. We have yet to see those prices in any of the big name stocks in the complex. When we take you look back to other big blow-offs, you take a look at the NASDAQ, the dot-com bubble in 2000. You take a look at Triple D, the 3D printing phenomena that was all the hype there a few years ago. Typically, this type of evolution, as it moves through the cycle in terms of the stocks, you go through that point of exuberance, everybody just dreaming of what the future can be for it, to the reality. And it's usually a 2-year window from the point where things start to break down until you bottom, and it can take the better part of a couple of years here to put in a base. So I would suspect that there might be some short-term trading opportunities within the cannabis stocks, and there's a lot of big hype still coming through. If you take a look at the market letter writers, it's amazing how many of them at this point are now looking at the U.S. as the next potential. Now that Canada is behind us, I think you're going to have to be very, very nimble there, because in reality, only a small percentage of the companies that are in that business are going to make it. And to try and pick the next Amazon or Facebook or anything of that sector, the odds are far, far and away against you. Let the market stabilize, and then watch to see which ones are the strong ones coming out of the bottom. And go with the leaders. I mean, that's, in most sectors, that's where you want to be. You don't get usually the biggest percentage gains immediately on the strong stocks. You get the biggest percentage moves on the most oversold ones. But then they don't have the prolonged ability to continue with a move. So, decent bounces are probably possible, but it's I think for the average investor, you probably want to stand aside for now.
I remember it was 3 years ago, cryptocurrency was sweeping the nation and the planet. Bitcoin was at 20 grand. So far, this year it doesn't seem like Bitcoin was all that great, and a lot of those cryptos have disappeared.
Oh, yeah. I mean, gosh, you take a look. It's only, in terms of the ones that are actually out there and trading, there's very few of them that have any decent volumes in them at this point. You really do have to stay with the big names, and even at that, the action has not been all that favorable. Well, you got Bitcoin went from 20,000 down to 3,500, bounced back to 12,500. So, it retraced 60%. But, here we are back down at 7,000 again. So it's given up, from 12,500 down to 7,100. It's given back 40% again. So, it's early in the game, for these items. For the average individual, it just, to me, doesn't look to be that a place to be. Then again, the hottest ones these days, you take a look at the FANGs, Facebook, Apple, Amazon, Netflix, and Google. These guys, they're now 40% of the NASDAQ index. This talk about an overweighted factor for any marketplace. Now, the advanced decline line for the NASDAQ is looking good, and for the New York Composite and the S&P, but there still is an overbalance of some of these just excellent stocks in there. And, maybe the biggest surprise in the next year is that some of these big names, for all that they are flying right now, maybe it'll be time for their correction.
Precious metals appeared to have come to life as we end the year. Is that going to continue?
Well, the seasonal turn that we were looking for has really come into place nicely here. The typical action is that silver and gold will typically put in a November or December low, and I think the optimum for gold is that you buy it on Boxing Day. And this year has been right on track for as far as that's concerned. We finally broke out through resistance at the 1495 level, and in quick succession, a matter of a couple of days, tacked on $25. The silver market, even more explosive, got up to 1815 or so on its first run. Our targets have been 1805 as a minimum on this seasonal play, and the optimum is more up in the 1935 range. If these two can just have minor corrections in the next week or so, they could continue on higher, because they did get pretty overbought very quickly. The big picture model is that once gold manages to come to life with more than just this little rally we've had so far, which is only corrected back 62% of the decline from the summer high. So at this point, it's still trying to prove itself that it's out and running. But if the correction is mild and it then comes back to life again, the big target that we're talking about now is going to be up at just shy of 1900, 1888, when we measure the size of the base that we've come out of here, this 5-year base. That becomes the ultimate target for this run. This run, quote unquote, being maybe 1, 2, 3 years. Who knows? We'll just take each turn as they come into place. And the silver target, respectively, would be somewhere up around the $25 range, given enough time.
Ross, have a great holiday season.
Yes, and you enjoy the rest of yours, and Happy New Year to one and all.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, market historian Bob Hoye, next on This Week in Money.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob, and best of the season.
Best of the season indeed. And yet we've got New Year's to get over yet, but how was your Christmas?
Beautiful Christmas. And of course, in Vancouver, no snow. We only get snow 1 out of 9 years, but down on the valley, the Fraser Valley, right next to Vancouver, it can get very interesting, is the most polite way to put it this time of year.
Yeah, well, it was so nice to be with family and friends, so.
That's always the best part. Who cares about the weather?
Yeah.
Now, for people who haven't maybe heard Bob's show on HowStreet.com, our format usually is we take a couple of listener questions and then we get into the headlines of the day. Plus, with Bob, we'll be reviewing what happened with the markets over this year. But first of all, Bob, we'll start off with a couple of listener questions. Bob, hi. Gold stocks and silver have taken off this December along with the equity markets. Has the precious metals sector joined the historic bull run in equities and now have become part of the everything bubble?
Oh, yeah, that's a good question. In Canada, the gold stocks have been a really good performer, and we've had a good trade. Because actually, the low was a key low was in November a year ago, and we had the buy for November 1st, and the next low was in the middle of the month, and terrific rally out till July, August, when they got overbought. And we advised taking a little money off the table. And then more recently, my colleague on the technical side had a very nice buy on silver and silver stocks. But those now are getting a little overdone on the upside. But for the longer term view, and the question does ask if the action in gold stocks is getting with the action in the big market, and yeah, sort of but in the longer term, we've been in a great financial bubble, and with that, the real price of gold has declined on previous such bubbles, and it certainly did with this one, with the blowout in 2011, and then it fit with the big bubble we have had, which is still on, and gold shares underperforming. But this is setting up for a long bull market in the gold sector, the precious metal sector. And the other part of the question is something about when they can really get hit. And yeah, if we get a sharp correction in the big stock markets somewhere in the new year, it would set back the gold stocks, and particularly now as they are somewhat overbought. So they're a fascinating sector, and one should have exposure in it, but one should always make sure that you're not buying high and not selling low, and this is where our technical work has been so helpful. So,
second question is the Fed afraid to let some of the air out of this bubble of everything?
Yeah, that's an astute question. The central bankers have gone crazy. They've become unusually reckless because they've assumed that they have to look after the economy and manage the economy. And they do this through manipulating interest rates and manipulating the value of the currency. And so recently, for the last decade when growth was slow, during the Obama administration, they were really pushing the money supply and were worried that it had to get inflation up to 2% and all this sort of stuff. And all it does is provide extra easy credit for the public in whatever they want to speculate in. And so you ended up with this huge residential real estate speculative housing bubble, immense, particularly here in Vancouver, which was extraordinary. And that was due to the central bankers having a theory that doesn't work. Because their theory is that if the central bank expands credit, it automatically pushes business. But this is there when you look at the business cycle over hundreds of years, the credit does expand with business expansion, but one doesn't cause the other, whereas the central bankers have made a classic blunder in assuming that if they push credit, it'll push the economy. And that is like the old one about in the morning when the rooster crows, it causes the sun to shine. It is that simple. So what you have happened is that they think they're going to get economic growth, and the U.S. now has a boom, mainly because of the Trump reforms that are going on with lower corporate taxes and a friendly environment. So billions and billions of corporate money has come back into the United States. And so you have a firm economy in the U.S. at the moment. So anyway, so the point I'm trying to make is that it deals with the question is about the Fed being able to keep everything going. And no, the markets will become overbought. They're becoming a little overbought. Then also there's certain seasonality to the stock markets where, and this really worked for us in 2017, where we were looking for that bubble, and that was included the blockchain and all that sort of stuff. And we thought that one could conclude around the turn of the year, and the Bitcoin bubble blew out in the middle of December, and then other indexes, the senior stock indexes, as well as indexes around the world, all had an important peak in that January 2018, and then quite a good correction, and then since December a year ago, hey, it's been an outstanding year. But the point is that the markets will get overbought and they'll get oversold, and you want to be able to measure them, and that the concept of the Fed now focusing on buying bonds, and other central bankers are buying equities, hoping for economic benefits, really is naive. And you've got central bankers long the stock market, and stock market's overpriced. So it'll be fascinating, Jim, to see how all this works out over the next year or so. But it's a good question.
Another listener question, is the Fed afraid to let some of the air out of the equity bubble?
Yeah, that was a key part of it. Oh, yeah, they're scared stiff of deflation. And that's where part of what I said is that they've been trying to keep inflation above 2%, which is ridiculous. You can have, and history shows that you can have long periods of sound economic growth without currency manipulation and without interest rate manipulation all through the 1800s when England was the senior currency. Through most of those periods, it was stable, next to nothing inflation, and business looked after itself. So it's a false move by the control freaks in central banking to assume that they need to be there to do things. And now, of course, they're being long the stock market, and stock market overpriced. They're very much interested in keeping the bull market going. But market forces are such that at some point the speculation will fail. And that is going to be interesting because it's not just the public speculating in the stock market. You've got the central bankers, senior central banks around the world have been speculating in the stock market as well. So that'll be an interesting event when it happens.
Well, take, for example, the Bank of Japan will own over half of the country's major companies, over half of each one of those top 50 companies because they're buying ETFs.
Yeah, because they think that buying the stock market will help the economy. Yeah. No, it's honestly, Jim, it's sort of a collective madness where they've got a theory, they have the control at the moment, and I don't think it's going to work. At some point, this will fail. Every financial bubble has failed in the past, and before they fail, the convictions that the bubble will continue have been very firmly held. Mind you, because, people who are long have been making money. And it's always natural to assume that it keeps going. So, but what we do is keep track of the credit markets, which are, in the last few months, becoming adverse. Not to the point of danger yet, but to the point of saying, hey, there's a heads up here, there's an alert here, and we've got to watch for the technicals on the stock market. So, well, between our historical work and having a very good technical models to analyze the market, we've been in pretty good shape.
Bob, is one of the worst things you can hear, it's different this time?
Oh, yeah. Yeah, I've got one. There was a great bubble in 1873, and one of the leading New York newspapers editorialized that, yes, it's speculative, but nothing could go wrong. And the reason is that the U.S. did not have a central bank. They had, it's called the Treasury system or the national banking system. And the head of the Treasury was considered to be a very fine man, and that at a liquidity crisis, and because the U.S. was not on a gold standard, the Treasury could issue any amount of currency and all would be well. But at the same time, that was the year that in England, the editor of the Economist magazine, Walter Bagehot, who was highly regarded, he published his book called Lombard Street, and in it he then claimed that the Bank of England, which was then on a gold standard, would be able to prevent bad things from happening by issuing a whole lot of credit. So here you had an editorial in New York saying that nothing could go wrong because the U.S. did not have a central bank, and you had the editor of The Economist in London saying that nothing could go wrong because you had a central bank. And, of course, it went wrong. You had a bear market that was 5 years long and then a 20-year contraction, recession, depression, call it what you will. Anyways, in England, which was then the senior economy, in 1884, the contraction was, the weakness prevailed, and senior economists started calling it the Great Depression, which began in 1873 when the bubble ended, and it ended in 1895 when then the next great expansion followed. So, and then you want to go to 1929 when John Moody of, Moody's credit rating, he said that nothing could go wrong. And the reason is that the old and terrible financial system was gone, and they had the new scientific and flexible Federal Reserve System. So, and that was going into the height of the 1929 boom, and it was nothing could go wrong. And of course it went wrong. And this is where also your question that led into this, Jim, was that this time is different. And then you move ahead to 2007 on that terrific bubble, and Greg Mankiw, who is a highly regarded economist at Harvard, he said that nothing could go wrong. And the reason was that there wasn't a new instrument handy, but it was that the Federal Reserve had a dream team. He used the term dream team of economists, and nothing could go wrong. So what went wrong? Well, hell, eventually the establishment was calling it the Great Recession, the worst contraction since the 1930s. So here we are. At the moment, all leading figures are saying that nothing can go wrong. And because the Fed is again providing credit, and the other senior central bankers are buying equities, so nothing can go wrong. And we'll see what happens over the course of next year on the concept that nothing could go wrong, and this time it's different. And this, Jim, that was the right phrase to bring out, because it's based upon the fact that you're making terrific gains, and it's a wonderful world, and it's going to continue. And especially when you got officialdom, like treasury systems or central banks, all along the same story. So all we can do is provide perspective and technical guidance, and hey, that's our job.
We'll have more with Bob Hoye when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Bob Hoye. Bob, the Trump stock market rally, according to a headline, has been one of the best under any president over his last 3 years. Is he the factor, or is it just the right place, the right time?
Yeah, what they did is count the 3 years since Trump won the election, and it's been terrific. Yes, there is something real with it, because it's attempting to reform big and aggressive and belligerent government, which the more belligerent they are, the more taxes they take, it seems. So he's making the U.S. back to more friendly for people doing business, and a lot, huge amounts. I don't know whether it was up to the trillions, but anyways, tens and tens of billions of dollars were parked outside of the U.S. because during the Obama administration, America was very unfriendly to business. So then quite the earth-shaking election where people are getting fed up with too much in-your-face and too much in-your-wallet government, and I've been calling it a popular uprising. And in 2016, the popular uprising in the U.S. chose Trump as an executive, and the establishment in the States figured there's no way that he could win, and he won. So this is a popular uprising, and as it continues, and it's being joined by other countries, more recently England had a stunning election result in discarding intrusive political parties. I mean, Labour had its worst setback since 1935. So this is a real movement, and so in answer to the headline that the 3 years have shown a terrific return out of equities, and yes, part of it is due to reforming government as best can be done in the States, and making a better climate for business. And it's showing up in the stock market, which, again, I'm going to emphasize, it is very overpriced. But when the market first started to go, it was immediately with the election result on November the 8th, 2016. And actually, here's one of our technical things is, previous to that, November the 3rd, the market had been selling off, and our technical thing got a sequential buy on the S&P. So that was the week before the election, and so then people began to call the terrific bull market out of the Trump election as I was using the term rational speculation, rational enthusiasm, that sort of thing. And it was because the market was discounting the reform of intrusive government. And it's continued, and now here we are again with the market continuing, but now somewhere in getting overbought, you got to take the rational out of it and say that the enthusiasm is becoming irrational. But I think we'll be able to call that when it comes. But it's an important reform, mainly against big and intrusive government, and getting back towards the Constitution of the U.S., which is always been a government by the people, not by experts, and the freedom of the individual has been important, and then also limited government, that the powers of government are limited by the Constitution and by the checks and balances of the way they structured their political system. And the checks and balances are gone. But this is early stages of what could be a fairly extensive political reform back to limited government, which has always been the healthiest thing for individuals. And I'm welcoming it, and I think it will be successful. And it might take even a bear market in the stock market to shake everything out.
Another headline that you liked, Bob, was apartment building permits in the U.S. have hit a 4-year high for rental housing. Is that a good sign for the U.S. economy?
Oh, yeah. Yeah, it's I guess with less regulations and stuff and a shortage of rental units, the market has suddenly become hot for them. And like anything else, it'll probably get overdone. But nonetheless, you've got a terrific headline there that you've got a boom in building rental accommodation. And also there's been a boom in building condo units and things like that, and also individual housing. So, hey, this is the good stuff that's showing there. And we're delighted to see it, but also we want to keep an eye on just how highly speculative the financial markets have become.
Now, Bob, from a historical point of view, all the unrest in Hong Kong, and Hong Kong being a major financial center, could that unrest and trouble with the local economy spreading outward hit the rest of Asia?
Yeah, well, it's remarkable what's going on in Hong Kong. It is a popular uprising against a brutally authoritarian government in Beijing. I believe it will be successful. But you can't, I don't think I want to go from that this turmoil in Hong Kong will force a contraction. It certainly has dampened speculation for their real estate market, but that's the history of Hong Kong. Highly speculative real estate market, and decades ago, I think the weighting of their stock exchange was about 40% real estate stocks. So, yeah, it can dampen speculation, but I don't think it'll force a contraction. I think what's going to happen is that as the next contraction comes in, you have, it's not just Hong Kong, you have the southern provinces of China, which has become where the boom is focused on, mainly the most productive sector, and where the freedom is appreciated. And so you can call that the southern provinces of China have been an extension of Hong Kong and Taiwan. And outside of the depressing abilities of a communist government in Beijing, but also the communist government in Beijing has been corrupted, such that many of the leaders are filthy rich, making huge money in the stock market. But I think what's going to happen here is that the central government in Beijing has enjoyed terrific tax revenues. So if you get on the next contraction, those tax revenues, Beijing will continue to demand those revenues. But those in the southern provinces that generate the revenues, and also they also like freedom, so I think there'll be a showdown. I think that at the end of all of this is going to be, you can call it a reverse takeover, where Hong Kong takes over the government of Beijing. And now that would be something. And I've been mumbling about that one for a number of years. And it could happen, where it's another one of these showdowns where the authoritarians demand the money, and those that make it say, get the hell out of here. We're not going to surrender our sovereignty and our money to a bunch of communist bandits in Beijing. And there's an old Chinese saying, may you live in interesting times, and this is going to be interesting. So in response to your question about Hong Kong, I think the uprising in Hong Kong will probably be successful, and it'll probably spread to the rest of China.
We'll have more with Bob Hoye when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Bob Hoye. Bob, how did the markets do overall in 2019?
Outstanding. For the stock market in the U.S., and that's the main market, because you went into a disaster. Well, I called it Dismal December a year ago. And now I remember that. On December 26th, a year ago, and there was tremendous pressures on crude oil. It was selling off, and the stock market with it. And our technical work came up with a sequential buy on the S&P, and in the same week, and also on crude oil. So then it all sorted itself out, and then you've had this terrific rally since. And we can sum this up, Jim, by saying that there's a number of examples over a long period of time where a very speculative market has concluded in the December-January window. 1973 was a fabulous bull market, followed by the worst bear market since the 1930s, and that peak was, January 11th. And then moving forward in 1980, which the incredible speculation in gold and silver, and I think the date on that one was January 20th, or thereabouts, plus or minus a day. And then you move ahead on the calendar to the end of 1989, when the fabulous Tokyo Nikkei stock bubble blew out. And that was, as I said, the last trading day of the year. And then you had the sharp sell-off after January 2018. So, and we're lofty, let's use the term lofty, at a time when there have been examples of previous lofty markets completing and then going into either a correction or a bear market.
Bob, if there is a correction in the new year, is there such a thing as a safe haven?
Yeah, you know, what we like for is you're going to get whacked in long, high-yielding bonds. They've been bid up immensely and have been correcting a bit. But that's dangerous territory. That's risk. So the ideal place for investors is around a 4-year good-grade corporate bond. And for Canadians, you could seek out some American corporate bonds, because if we go into a contraction, the Canadian dollar will go down relative to the U.S., and if you're owning some U.S. bonds, you'll be on the happy side of that trade. But if you're only out about 4 years, you know, you're not going to get whacked too much by any price moves, and it's a good, safe place to be. It's the street, the professional side of the street with fund managers, when they see a contraction coming, will then go to defensive stocks. As I joke, the defensive stocks go down slower than highly fashionable stocks. But that's another world. I mentioned also in long post-bubble contractions, the real price of gold does well, and so do gold stocks. So one should own some gold in one's portfolio and should have some gold stocks as well. They can get whipsawed around with the big stock market, but they will be the next group that will outperform the overall market. So you got two things here. You can probably one of the safest, the safest places is in T-bills, but short rates will go down, so you get screwed there. So then out to the 4-year in the bond market it's safe, it's reasonably safe, and you'll get a half-decent return out of it. But other than that, a few gold stocks and some gold, and that would be the place to weather a storm. And then if there is a storm coming in, you don't want to have any borrowed money, because it gets very difficult to pay back in a contraction. So
Well, Bob, the best of the season to you and your family.
Well, we're looking forward to the celebration of New Year's Eve, and we're looking forward to next year, and all the best to you and to our listeners as well.
We thank our listeners for some of the most interesting questions you'll ever hear.
Indeed. Keep the questions coming.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark and Bob Hoye, and thank you for listening. Now, if you have any questions for Bob or any of our other guests, you can send them to info@housestreet.com. Now, stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. Have all the fun that you want and a little bit more. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with American Manganese CEO and President Larry Reaugh. Best of the season, Larry?
Well, thanks, Jim, and best of the season to you.
And Larry, you were busy over the Christmas break sending out a news release by Reindeer, I believe. What was in the news release?
Well, the news release was about our Rocher de Boule property, which happens to be contain high-grade gold and cobalt, silver, well, you could name it, molybdenum, and certainly high-grade copper. It's an iron oxide copper gold IOCG target, and work that we'd done on the property this year had identified a drill target if we want to move in that direction. That really depends on where we're at with our battery technology, battery recycling technology, because we don't want to divert funds from that project if we don't have to. But on the great side of everything, is I've been watching the overall market in mining, and specifically gold and copper, and we're seeing a lot of strength developing, and we haven't seen that for a long time. So you might call it at least a Santa Claus rally for that. So I'm looking forward to an excellent year. I think we're seeing a great market coming up for the venture exchange. There's a lot of things that are working for it, certainly the price of copper, certainly the price of gold and silver, and that is the backbone of the venture exchange. So we're also saw a group that's developed a thrust to get the uptick rule reinstated. So that would be a big help. So a lot of things have kind of focused on having a good market next year. We got a lot of exciting things to look forward to. On the recycling front, we're working on the DOE, the Department of Energy's samples that they gave us. Some of these were from pouch batteries, and it taught us a couple of things about that too. There's an extra couple of steps that have to be taken in order to prepare the pouch batteries for recycling, and we've done that. So I'm expecting early in the new year that we'll get results on the samples that were submitted by the Critical Materials Institute, and which is part of the DOE initiative. So we got great things to look forward to. We've also got the Cometco will begin working on a submission to give us a what we would call in mining PEA, and a preliminary economic evaluation. And so that's our next goal, is to have that started early in the new year. I would hope by mid-January. And so it's we've got a lot of stuff on the plate, Jim. We've just gone through, or not, I shouldn't say gone through, we've almost completed the expiration of the warrants, 20 cents, and we got at least 35% of those exercised. So the Treasury's looking fat, and we won't have to do any financing for, well, at least a few months. So that everything is kind of came up, had a good ending for the company for 2019, and we're anxiously looking forward to going back to work in 2020 and getting some real big developments happening for the company. So that's we've got an agenda. We've had a wonderful year in 2019, and we're looking forward to a better year in 2020. So it's all I can say is that we're looking forward to a prosperous new year and a happy new year, and we wish that to our shareholders and the people that are following us in the market. So that's probably, I don't have a lot more to say because the office was shut down most of this week. And so we haven't had any new developments. Everybody shuts down, including Cometco. So Happy New Year, everybody.
Larry, for people new to the company, where are you traded and where can they get more information?
Well, we're traded on the Toronto Stock Exchange Venture under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in the Frankfurt Exchange under the symbol 2AM. You can get any information that you require from the company. We have a well-appointed website, and so you can go to AmericanManganeseInc.com, or you can phone the office at 778-574-4444, or email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update and best of the season.
Same to you, Jim.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on December 27th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.